In this video, we're going to go over Pdd Holdings, ticker symbol PDD. Over the course of 1 year, this company is up 37.7%. Year to date, up 11.45%. We're going to go over the company's most recent earnings release, which is their 6K. This is a foreign company. Also, after that, we'll check out the valuations and come to a fair market price and a 30% margin safety price. And after that, we'll take a look at the stock chart and see if we can figure out where price action might be headed on PDD here. So we'll begin on the balance sheet. We can see here on the two left columns are the foreign currency. The column on the right is US dollars. We have, in terms of US dollars, 4.3 billion in cash. We have restricted cash of 7 billion, which if you add these two up together, that's their cash and cash equivalents once we get over to the cash flows. Down here we have short-term investments of $20.4 billion. So they're really putting all the majority of their capital to work to earn interest on that capital instead of just letting it sit in the bank. So their total current assets, 33 billion. Their cash and cash equivalents with their short-term investments and their cash and cash equivalents is $25 billion in total. So a solid amount of cash. They have a minimal amount of intangible assets there as well. At the liabilities here, we can see we have payables to merchants, about 8.3 billion. We also have accrued expenses and other liabilities. There's a chance that restricted capital is used for one of these two regions here, whether it's accrued expenses or other liabilities, maybe payable to merchants. Regardless, that restricted cash is either used for paying down debts, loan reduction, capital investments, something like that. But I'm sure we could dig into that and find out exactly what they're potentially using that for. Convertible bonds. They have $2 billion in convertible bonds. Once this is converted, this will likely add share dilution to the bondholders, or to the shareholders, I should say, because the bondholders will likely want to have shares in replacement of these expired convertible bonds. They have nominal amount of lease liabilities. We can see down here in the future, we're going to have a little bit more of some convertible bonds coming due. So that's pretty nominal on this one. It's a lot less than 2 billion. So overall total liabilities, we have 17.8 billion in total debt. Retained earnings. There is $5 billion of retained earnings that this company can use to do internal financing, maybe future dividends, or pay off some debt. We also see an increase in shareholder equity. Down here at the income statement, this is a little messy, a little difficult to read. We have both of our year over year foreign currency and then our USD all the way here to the right. So we'll come down here. We have revs increased 32% year over year. Cost of revenues increased 27% year over year. Gross profit margin is 67%. Our operating expenses are up 22%. And we can see right here the increase was all in sales and marketing, which is pretty good. If there's going to be one that I want to see an increase in, is it going to be either this one or sales and marketing? We don't want to see them hire more people. But sales and marketing means that hopefully this company will start generating even more revenue because they're marketing their products. So now we have operating expenses are soaking up 45% of revenues. We are left with 22% operating profits. Net income year over year has increased 41%. So our net income overall in the last 6 months is just shy of $3 billion. One thing to note, after our operating profits here, our interest from all that from the $20 billion invested, they made $517 million. So that gets added on to this down here, and in total gives them a total net income of $2.9 billion. So we can see $2.9 billion. There is, for every 4 ordinary shares, there's one ADS share. So in total, there's 1.46 billion shares. 1.46 billion divided by that gives us 2. for $2 earnings per share in the last 6 months. We can see in the last or year over year, we went from 5.7 billion shares to 5.8 billion shares, so it's a 2.4% share increase. Their share-based compensation, all in all, they acquired 700 or 472 million in terms of share-based comp, so they increased their capital, which I think they could stop doing with how much capital they have. So 4.7 billion or 472 million in the share-based comp plus the net income gives us a cash from operating activities of $3.4 billion. We then net cash used in investing activities, we saw a loss of 4.7 billion. Our short-term investments went from 115 to 148, so that's about a 33 um, billion-dollar RMB increase to the short-term investment side, which on cash flows is going to show up as a negative. So right here we can see 34. So basically almost all of it was all the net cash used in investing activities was put into long-term or short-term investments to, generate more interest income. Nothing wrong with that. So we add plus that, and then add that as well. It gives us a total decrease in cash and cash equivalents of 1.2 billion. So we went from 12.7 billion, and remember this 12.7 billion is cash and cash equivalents plus restricted cash. So now in the cash and cash equivalents column, we lost 1.2 billion. So in total, we're down to 11.5 billion in cash and cash equivalents. So nothing wrong there. Super solid balance sheet. I have zero complaints, zero concerns on that. The only thing is just what is the restricted cash for? That's the only question I have on this balance sheet. Over here we have company statistics. This company does not pay a dividend. Their financial efficiency, return on equity is 33%, and this is over the course of the last 12 months. Return on invested capital over the course of the last 12 months is 72.3. Gross margin in the last 12 months was 71. Today it's 67, so we're seeing a decrease in gross margin. That is a bit of a red flag. Operating margin, we went from 23 down to 22%. Again, not less than ideal there. The analysts have a price target of $114 per share, which is they also are predicting a 16% revenue growth rate. And compared to where the stock is trading right now at $94 per share to 114, there's an 18.5% increase. So down here, revenue year over year, we can see has grown year over year very nicely, percentage wise. Starting to slow down percentage wise, predicted to slow down a little bit. And then there's only two analysts predicting the 2026 numbers. So we can see still got solid revenue growth moving forward. Our earnings per share growth also a solid. Peter Lynch valuation. Our return on invested capital today is 19.3%, big difference from 72. However, we're still above 15%, so nothing wrong with that. There could have been some big return on invested capital on one of the quarters which skewed that 72% up. So either way, we're at 19.3%, which is still that's a more normal return on invested capital number anyway. Overall, Peter Lynch valuation gives us a 1.2, which we see down here in the key, which is fairly valued. Gives us a Peter Lynch fair value price of $113.66 per share. Multiples comparison. We have Baba, JD, and Melly. Gives us a multiples price of $172 per share for PDD. Our manual PE, got our market cap, our cash minus our debt, cash from operations, gives us a 17 multiple before we equal our market cap, which based on our key here puts us below undervalued. So again, another undervalued one. Price to book ratio, currently trading at 8.87 price to book. Over the course of the last 5 years, it is trading a bit rich based on price to book. PEG ratio, very undervalued PEG, price to earnings divided by growth, giving us today a 0.95. Forward looking, looking at 0.65, very, very undervalued. Graham's valuation over here, intrinsic value, 29.3%. I left the AAA corporate bonds as what we have over here at 4.95%. This could be less, um, based on, I believe this country's based in Ireland. So this could be a different number here. Even if we type in 2%, it's not a huge, huge change in overall intrinsic value. Come over here to the discounted cash flow, weighted average cost of capital, we get 7%, 6.94%. Perpetual growth rate 2.5. Forward free cash flow percentage growth of 34%. Over the course of the last 6 years, we can see our cash from operations continue to just kind of slowly increase. And then we had a big jump between 21 and 22. CapEx here is very, very, very minimal in terms of what our cash from operations are. Gives us an analyst growth rate, 34%. Our average growth rate, 46.7%. So 34 is going to be our number. Our 34% growth rate on free cash flow gives all the way to our terminal value. Gives us a discounted cash flow price per share of $468.88. Rule 72, current EPS 3.88, current PE 24.55. Lowest EPS growth rate, we had 3 here and 29, so I'm going to use 20 for our growth rate. 20 goes into 72, 3.6 per times, 3.6 goes into 10 years, 2.7 times. 2.7 times, will double our earnings per share 2.7 times over. So right here, we're closer to 3, so we'll do 31 for our future EPS. Gives us a fair value of $454, 30% margin of safety of $317 per share. Over here, we have our summary of all of our valuations. Our average price of all of our valuations is $247. 30% margin of safety is $173 per share. Some of the good here, we plenty of cash to cover all debts, utilizing majority of their cash and have it being put to use on short-term investments to generate more interest income. $5 billion of retained earnings. They have the potential to offer a dividend if they want, pay off some debt, do some internal financing, potentially buy back some shares. They have overall income statement looks solid, reasonable percentages on each bold line item. Their net income increased 41% year over year. They are not coming out of a trough, but there was a question to be had. The bad, there's more share dilution likely in the future here. It had $472 million of share-based comp. Basically, the bad is just correlated to the shares. If they can stop, diluting the shareholders, that'd be very helpful for this company to grow some more. There'd be more investors wanting to purchase this company, well, and not keep on getting diluted. Another negative too, that while we were going through this, was the decrease percentages in their gross profit is a negative. So we can see here our gross margin fell and our operating margin also fell. Over here to the stock chart, we can see PDD at an all-time high of $212 per share. And then through the course of 2021 came all the way down to like $25 per share and is now back in this uptrend. And currently, based after its earnings report here, I believe it was on the 29th of August, shot the stock up to $103 per share, and currently we're pulling back. We're sitting at about $95 per share. It makes sense where it got rejected. It gapped up, pushed up to the top of this channel, and is now getting rejected. However, there's a chance that this gets rejected a little bit and it resumes higher, or just stays within this channel and continues higher. It could pull a FANG stock like an NVIDIA or a Meta and just continue higher through this channel. But based on the financial side of things for this company, not including any fundamentals, just the financials, the numbers, it looks like this company is very well ran. It's got plenty of cash, very little debt, and is forecasted to grow very nicely in the in the future. So there's nothing here that's too concerning at all. There could be concerns in terms of the fundamentals. That is up for you guys to determine and research yourself because that is a very opinionated way of looking at a company. Personally, I like PDD. Financials look great. Stock chart looks great. I there's not much to hate on. But that's it for PDD. If you guys found value in this video, drop a like, subscribe, and we'll be back later with another stock analysis video.